Hey everyone, ready for another deep dive?
Always.
Taxes on the brain today.
Yeah, getting ready for that 2023 filing season.
And we're going deep, like really deep, using,
Publication 17. Straight from the IRS.
yep. So if you're feeling a little overwhelmed by the whole tax thing,
Totally understandable.
this is for you.
We'll break it down, make it, well, maybe not fun,
Yeah, not promising fun.
but definitely clearer.
Yeah.
And who knows, you might even find some little tax advantages you didn't know about.
Ooh, secret tax loopholes. I'm in. Okay, so first things first.
Got to start somewhere.
Do we all have to file? Like, is there anyone out there who can just skip this whole thing?
Good question. I mean, most people think taxes, got to file. But Publication 17 actually says, not so fast. It's not always a requirement.
Really? So who gets to sit this one out?
Well, it depends. Citizenship, residency, income, it all plays a role. U.S. citizens, residents, even folks living in Puerto Rico, got to pay attention.
So location matters.
But then the biggie is your income.
Okay, so how much do I have to rake in before the IRS comes knocking?
Well, that's where those filing statuses come in. Single, married, filing jointly, all that jazz. If you're single and your gross income, now we're talking about that total income before any deductions.
Gotcha.
If that's under $13,850,
Yeah.
you're probably good. You can probably relax. Married couples filing jointly, a little higher threshold there, around $27,700. But hold on.
There's always a but with taxes.
Always. We got to talk about those nuances.
Nuances. Uh-oh, what did we miss?
Social Security benefits?
Social Security. I thought that was, like, separate from all this.
You'd think, right.
Yeah.
But Publication 17, it says they're usually not included in your gross income.
Wait, really? So even if I'm living on Social Security, I might not have to file?
It's possible, but, and this is important,
Knew there was a catch.
if you're married filing separately and you live with your spouse at any point during 2023, then those benefits, yeah, those might come into play.
Okay, so maybe not a total free pass. Are there other situations where Social Security benefits become,
Taxable.
yeah, taxable?
Oh, yeah. Publication 17 gets specific. But the general rule, if half your benefits plus your other income and any tax-exempt interest exceeds a certain limit.
Okay, this is where my brain starts to melt a little.
That's a lot. But basically, for single filers, that limit's $25,000. And for joint filers, it's $32,000. So if you're over that, well, part of those benefits might be taxable.
All right, starting to see how even something like Social Security can get tricky. And tax laws, they're always changing, right?
Oh, constantly.
So what's new for 2023? Anything we should be especially aware of?
Well, one big one for families is those enhanced child tax credit amounts. Those have expired.
Whoa, yeah, those were helpful.
So parents, be prepared. The credit might be a bit smaller this year.
Ouch, not the news parents wanted to hear. Anything else standing out as a big change?
There are some reporting changes scattered throughout Publication 17, like scholarships, pensions from certain non-qualified plans, even wages earned while incarcerated. All those are reported in new locations.
Gotcha, so gotta pay attention to the details. Okay, so let's say I DO need to file. What are my options? I'm picturing mountains of paperwork.
Oh, no, you've got options. E-filing, it's like the superhero of tax season. Secure, fast, so much easier than dealing with all those forms.
Definitely pro-easy over here, but can
Okay.
I still file the old-fashioned way? Like if I enjoy paper cuts?
You can, but you might need Form 845E3 if you have documents that can't be e-filed. And if you're hoping for a speedy refund, direct deposit is the way to go.
Direct deposit, my love language. Any quirks to that process I should know about?
Well, there's a limit. 3 direct deposits to a single account or prepaid debit card per year. After that, paper check time. But you can split your refund, send it to multiple accounts, up to 3.
Ooh, strategic. Okay, last question before we really dive in. What about those of us who, well, need a little extra hand-holding during tax season? Any resources out there?
Absolutely. VDI program, volunteer income tax assistance, amazing resource for folks making $64,000 or less, people with disabilities, anyone needing help in a language other than English. And there's the TCE program, tax counseling for the elderly, focused on those, retirement-related tax issues.
Perfect. Now ready to get into the nitty-gritty.
Let's do it. Time to tackle income and expenses.
This is where it gets real. Hit me with those key concepts.
First up, accounting periods. Got to get that foundation right.
Accounting periods. Sounds intense.
Most individual returns, they're based on the calendar year. Simple. But if your finances align better with a fiscal year, you can go that route. Key is consistency.
Okay, consistency makes sense. But what about those times when income, like maybe you don't receive it in the same year you earned it?
Ah, that's where constructive receipt comes in. Basically, if you have access to the income, even if you haven't touched the money, it's taxable in that year. Thing like interest credited to your bank account on December 31st, even if you don't withdraw until January, bam, taxable for that previous year.
So no delaying those tax obligations. What about garnished wages? Where do those fall in the reporting mix?
So even if your employer's sending part of your paycheck to someone else for a debt, you're still considered to have received the full amount, all taxable in the year you would gotten it.
No escaping the tax man. Okay, let's talk about record keeping, everyone's favorite topic.
Oh yeah, the highlighted tax season.
So what are the must-haves? What do I absolutely need to hold on to?
IRS doesn't mandate a specific way to keep records, but whatever system you choose, it's got to clearly show that taxable income.
Yeah.
Receipts, bank statements, anything backing up those numbers on your return, keep it organized, keep it accessible.
And for how long? Asking for a friend who has a filing cabinet dedicated to old tax stuff?
I feel that.
Yeah.
Good rule of thumb, keep most records for at least 3 years, but some, like property or investment stuff, hold on to those longer.
Solid advice. Okay, last one, and this one's for the mistake makers out there. What if, hypothetically, someone messes up their return? Is amending a return a total nightmare?
Not at all. Form 1040X, that's your friend for amending a return. Just make sure you're clearly documenting any changes. Those calculations got to be accurate.
Sounds manageable, but are there times when amending gets more complicated?
Definitely. Unresolved issues like pending lawsuits, insurance claims, anything that could impact your tax liability. You might need to file a protective claim for refund. That protects your right to claim a refund later, even if you're past the usual time limit.
Okay, good to know. Now, this is where I get excited.
Oh, tell me.
Time to unearth those hidden tax secrets. What are some of the less obvious, maybe even surprising, things you found in Publication 17?
Oh, there are some gems in there. One that often catches people off guard is filing as head of household. Sounds simple, but
But there's always a but.
it's not just about living with someone. You have to be paying more than half the cost of keeping up that home for a qualifying child or relative.
So mortgage, utilities, groceries, all that counts.
You got it. Publication 17. It even has worksheets, examples to help you figure out if you meet the requirements. Don't just assume. Another interesting detail, Social Security numbers for dependents.
Wait, what about those?
Got to provide an SSN for every dependent you claim. Doesn't matter how old they are.
The IRS wants those numbers.
Okay, what else caught your eye?
Supplemental wages. This covers things like bonuses, commissions, overtime, basically anything that's not part of your regular salary.
So that holiday bonus isn't quite as carefree as it seems.
Might be subject to a different withholding rate than your regular wages, so definitely worth understanding how those are taxed. Publication 17 breaks it all down.
Got to read the fine print. Okay, one more before we wrap up this section. What about, this sounds scary,
What's that?
backup withholding?
Yeah. That's like the IRS's safety net.
Hmm.
If you don't give your correct taxpayer ID number to a bank or business paying you interest or dividends, they might withhold some of your money and send it straight to the IRS. So it's a way to make sure they get their cut, no matter what. Are there consequences for, giving false info to avoid this?
Oh yeah, Publication 17 is clear about that. Civil A&D criminal penalties. Honesty is the best policy.
Good to know. Now, enough about what we might OWE.
I like where this is going.
Let's talk tax advantages. What are some of those hidden gems you found lurking in the code?
Oh, there's some good ones. One that stands out, the Education Savings Bond Program. It's a potential way to exclude interest earned on those qualified U.S. savings bonds if you use the funds for qualified higher education expenses.
So it's like a tax break for college savings. How does that work?
Publication 17's got the specifics. Which bonds qualify, which expenses are eligible, even an example showing how that exclusion's calculated.
Super helpful. What other advantages caught your eye?
Tax treatment of life insurance proceeds received in installments. Might be able to exclude a portion of that interest income from your taxable income.
Oh, that's good news for beneficiaries. Anything else surprising?
This one often raises eyebrows. Certain disability pensions, especially those for federal employees and military folks, those can be tax-free.
Wow, really? But I'm guessing there are exceptions.
Of course. Accrued leave payments you get when you retire due to disability, those are considered salary, not disability payments. So taxable. Details.
This is fascinating, and I feel like we're just scratching the surface here.
Oh yeah, so much more to explore. But this is a good taste of what's out there.
Definitely. And remember, we're just highlighting the big stuff. For personalized advice, definitely check out the full IRS Publication 17 or talk to a tax pro.
Couldn't agree more.
All right, time to go even deeper. Next up, we're diving into the world of filing statuses.
Oh, this is where it gets interesting.
Buckle up, everyone.
It's crazy how much your filing status impacts everything else. It's not just a label, it determines your tax brackets, deductions, credits, the whole shebang.
Right, it's not like picking your favorite ice cream flavor. This stuff has real consequences.
Big time. And Publication 17, it goes deep on these different scenarios. Like, take married filing jointly. Sounds simple, but
There's always a but.
always. What happens if one spouse, passes away during the tax year? Can the surviving spouse still file jointly?
I have no idea. I mean, it can't be that straightforward, can it?
You're right, it's not. Publication 17 says if your spouse died in 2024, but before filing that 2023 return, you could still choose married filing jointly for the 2023 year.
So even though one spouse is gone, you can still benefit from that joint filing status.
Yep, exactly. But get this, if you're divorced by the last day of the year, you're considered unmarried for the whole year. No joint filing for you.
So no more shared tax benefits after that final decree. Speaking of filing statuses, we talked about head of household earlier and how tricky it can be to qualify. Publication 17 really dives into what it means to keep up a home for someone.
Yeah, it's not just about providing a roof overhead. You gotta be covering more than half the cost of running that home. Mortgage interest, property taxes, insurance, utilities, repairs, even the food everyone eats at home.
Wow, so even grocery runs factor into your filing status.
They do. Thankfully, Publication 17 has this handy worksheet to help you calculate those costs. Got to make sure you actually meet that more than half threshold.
Okay, that's a relief. Now, dependents, we already talked about Social Security numbers for them. But what about the types of dependents? Is it just kids?
Nope, not at all. Publication 17 lays out two main categories: qualifying children, qualifying relatives. Each has its own set of rules, like little tests they got to pass.
So it's not as simple as, like, anyone you help financially.
Definitely not. For a qualifying child, there are tests about relationship age, residence, support, even if they filed a joint return. Qualifying relatives, different criteria there, more about their income, the support you provide.
Got it. So there's nuance there. Like, what are some examples of these qualifying relatives?
Say you have an elderly parent living with you, and you provide more than half of their support. If their income is below a certain limit, they could be your dependent.
Makes sense. And Publication 17 probably breaks down, like, what kind of support counts, right?
Oh, absolutely. Food, shelter, clothing, medical care, education, even recreation. They've got examples to help you figure out how to calculate it all.
Sounds like it's time to dig through those shoe boxes of receipts. Now, income, obviously we all know about salaries and wages, but Publication 17 covers so much more than that.
Oh yeah, it goes way beyond your regular paycheck. Tips, bonuses, commissions, retirement distributions, gambling winnings, unemployment, even bartering income.
Bartering income, what's that? Like treating chickens for tax advice.
Basically, if you trade goods or services instead of cash, you still got to report it. Let's say you're a web designer and you trade your services for a new laptop. The fair market value of that laptop, that's income.
Wow, the IRS really thinks of everything. What about income from illegal activities, asking for a friend?
Believe it or not, Publication 17 addresses that. It says income from illegal activities, like, drug dealing. That must be included in your income.
So no matter where the money comes from, honesty is the best policy. Any other unusual income sources they mention?
One that sticks out is found property. You stumble across some cash, a valuable item that could be taxable income.
So finders, keepers, losers, weepers. Not always, especially when the IRS is involved. What about scholarships and fellowships? When are those taxable?
Good question. Generally, those are tax-free if you use the money for qualified education expenses, tuition, fees, books, supplies. But if you use any of it for personal stuff like room and board, that part becomes taxable.
So it really depends on how you use the funds. Are there ever situations where scholarships are fully taxable, even if they're used for education?
There are. Like if you win a scholarship as a prize in a contest and it's not related to academics, that's taxable income.
So it's not always a free ride. What about those tuition reduction programs colleges offer? Those are always tax-free, right?
Not necessarily. Publication 17. It explains those qualified tuition reduction rules are pretty complex. If you're an employee of the school, or a spouse, or dependent of an employee, then it might be tax-free.
But of course there are exceptions.
You know it. If that tuition reduction is basically payment for services you're doing for the school, then it could be taxable income. Publication 17 dives into all those scenarios.
Just again, read the fine print. Okay, let's switch gears to retirement income. Everyone's favorite topic, right?
Retirement. Exciting and potentially confusing. Publication 17 covers all sorts of plans. Traditional IRAs, Roth IRAs, 401ks, pensions, annuities.
So many options, and the tax treatment for those must be all over the place.
It is. Traditional IRAs, those contributions are often tax deductible, so you lower your taxable income in the year you contribute. But then when you take distributions in retirement, those are generally taxable.
So it's like delaying the tax hit until later, when you might be in a lower tax bracket.
Exactly. Now, Roth IRAs are different. You pay taxes on the contributions up front. But qualified distributions in retirement, those are tax-free.
So it's a trade-off. Tax benefits now versus tax benefits later. How do you even know which one to choose?
It all depends on your goals, your financial situation. Publication 17 breaks down each plan. The rules, the benefits, contribution limits, distribution rules, even potential penalties.
Sounds complicated. Does it offer any guidance on when to start planning for retirement?
It stresses the importance of starting early. The sooner you start, the more time your money has to grow with those tax advantages.
Always good advice. Now let's talk about something a little less fun, unemployment compensation.
Yeah, not the happiest topic, but Publication 17 explains how it's taxed. Those benefits, they're generally considered taxable income.
So even though you're getting those benefits during a tough time, you still got to factor them into your taxes.
That's right. You can even choose to have taxes withheld from your unemployment so you don't end up owing a bunch of tax time.
Good to know. Are there ever times when unemployment benefits aren't taxable?
There are. If your benefits come from a private unemployment fund that you contributed to, then only the amount that's more than what you contributed is taxable.
So you get your own contributions back tax-free. Interesting. What about other types of assistance, like welfare?
Publication 17 covers that too. Government benefits from a public welfare fund, those are not taxable. Payments to blind individuals, aid to families with dependent children, things like that.
So those benefits are truly designed to help without adding to someone's tax burden.
Exactly. But here's a catch. If those welfare payments are considered compensation for services, or if they're obtained fraudulently, then they are taxable.
Okay, so there's a clear line there. Now let's move on to something a little more exciting, gambling winnings. When are those taxable?
Any winnings from lotteries, raffles, casinos, any gambling really, that's considered taxable income. And it's not just cash. Got to report the fair market value of any non-cash prices too, like cars, houses, vacations.
So that dream vacation you win could come with a big tax bill.
It definitely could. And if you win a state lottery that's paid out in installments, you might have to report part of each installment as income each year.
So even if you spread out the winnings, those taxes follow you. Are there special forms for reporting gambling winnings?
Yep. If you win over a certain amount, you'll probably get a Form W-2G, certain gambling winnings. It shows how much you won and any taxes they withheld.
Like a W-2, but for gambling.
Exactly. Got to include that info on your tax return.
All right, this has been a whirlwind tour of tax concepts. I feel like we've only scratched the surface, though.
Oh, for sure. The tax code is a beast, constantly changing. But hopefully this gives you a good foundation, helps you understand how different income, deductions, credits, how it all impacts what you owe.
Definitely. And remember, we're just hitting the highlights. For specific advice, you gotta consult a tax pro or dive into the full Publication 17 yourself.
Absolutely.
Okay, ready to move on.
Bring it on.
Let's talk deductions and credits. This is where things get really interesting.
It's amazing how many deductions and credits are out there, like hidden in the tax code.
Right. It's like a game trying to find those tax savings. And Publication 17, it doesn't disappoint. What are some of the more obscure deductions that stood out to you?
One that people often miss is the deduction for student loan interest. So if you're paying off those loans, you might be able to deduct, let's see, up to $2,500 in interest each year, even if you don't itemize.
That's huge for anyone dealing with student debt. Are there, like, income limits or anything like that?
There are. You start to lose the deduction as your income goes up. Publication 17 has all those income thresholds, so definitely worth checking.
Another reason to pay close attention to those numbers. What about deductions for medical expenses? Healthcare costs can be a real burden.
Absolutely, and the IRS knows that. If your medical and dental expenses go over a certain percentage of your adjusted gross income, you might be able to deduct some of those costs.
Okay, that makes sense. What kind of medical expenses are we talking about here?
Publication 17 has a whole list. It's pretty comprehensive. Doctor's visits, prescriptions, hospital stays, long-term care, even insurance premiums.
So a lot of things qualify. This could be really helpful for folks with chronic illnesses or who've had like big unexpected medical bills.
Exactly. And there are also specific rules for those long-term care expenses, nursing homes, home health care. So if that applies to you, definitely dig into those details.
Okay, good to know. Now, this one's near and dear to my heart, charitable contributions. I love giving back, and it's awesome that there can be tax benefits too.
Right. If you donate to a qualified organization, you might be able to deduct some of those donations on your tax return.
What kind of organizations are we talking about? Is it just the big, well-known charities?
Not at all. Publication 17 explains what makes an organization qualified, and it's a wide range, from churches and schools to hospitals and all sorts of nonprofits that benefit the public.
So you can support those smaller local groups you love and still get the tax break. That's awesome.
And there are even rules for donating property, like your car, clothes, things like that. Helpful if you're downsizing or just cleaning out your closets.
Love it. Okay, switching gears to a less fun topic, casualty and theft losses. These can be rough situations, but are there any tax provisions that can help?
There are. If you have a loss from some sudden unexpected event, a fire, flood, theft, something like that, you might be able to deduct a portion of those losses.
So even in those tough times, there's a bit of tax relief. What kind of losses qualify?
Publication 17 gets into the nitty-gritty, but it basically covers losses to your property, your home, stuff inside, vehicles, even trees and landscaping.
Wow, it covers a lot. That could be a real lifeline for people rebuilding after a disaster.
It can. And there are special things to consider for losses from those federally declared disasters, so definitely check Publication 17 for the specific guidance.
All right, we've covered some key deductions and credits, but I know there's so much more in Publication 17.
Oh yeah, just scratching the surface here. The tax code is enormous, constantly evolving. But hopefully this deep dive has given you a good starting point, piqued your interest in those areas that apply to you.
I think that's the big takeaway. Understanding the tax code gives you power. We've highlighted some important points, but for personalized advice for your unique situation, talking to a tax professional is always the best move.
Absolutely. The tax code can seem intimidating, but taking the time to learn about it, it really can pay off. Stay informed, be proactive, and don't be afraid to get expert help when you need it.
So well said. Thanks for joining us on this deep dive into the world of taxes. Until next time, keep learning, and may your tax season be as painless as possible.